Alrighty, Doc here from North America. Good morning, good afternoon, and good evening. Definitely a fascinating day, that's for sure. Um, there was some really interesting news out last night after the market closed here in the States about the sloppiness of the mechanics. We talk about that here a lot of times. In other words, it's not just choosing a direction of a product, but it's also the physical mechanics to it. In other words, the way the system works with margin and liquidity and information and the lack of information and so forth. And because GameStop and the rest of them today are under the microscope in I guess I don't know how to describe it. Washington D.C. I guess that's the best way to describe it at this point. That is going to be somewhat of the push. And last night on CNBC, the head of Interactive Brokers, Pettifor, Tom, he basically pointed out all the chaos that's going on inside the financial system through the physical mechanics of it. So in other words, it's it's lacking. There's a lacking of actual rules that will keep things orderly. And he said that pretty much the system was getting very close to what he calls a collapse. I think he's exaggerating a little bit there, but Tom is not someone to be laughed at in the sense of when he looks at things. He's been in the market since the 90s, or no, the 80s. I traded with him on the trading floor then, and he has a very successful brokerage house, and it's a very smart brokerage house and so forth. So, if he says that the system was getting close to physical collapse, he's probably right. Now, they do things called force de jour. It would stop the collapse. But the thing is that it still would be some form of a collapse, and they'd have to suspend rules. And the short side of it, of delivering, was the mechanical problem of it all. So anyway, you're going to see that noise out there today. Same token, there's also a pretty good article about was it the repo market. We talk about interest rates around here, and there's real serious talk about a verge of a major shock inside the repo market itself. That's the short-term money that's lent to the banks and the brokerages, and so we're getting a double whammy here over the next. There's supposedly a tsunami of about 800 billion in extra liquidity hits the market over the next 6 weeks, and a total of about 1.1 trillion. That's about 300 billion more in the next 10 weeks. And the flood of liquidity combined with the repo market could really squeeze things, and that's what we're seeing right now. That's what Pettifor was saying from Interactive Brokers. That the squeeze and the information is messing things up. It says there's a hole in the system, and more than likely, I have to agree with him. There is a hole in the system, and it needs to be repaired. Titus, hey Titus, how you doing? All right, so you can see here, starting off, we got the Swiss franc. It's moving down a little bit, so that means the dollar is moving down this morning. There's some weakness there. I believe we saw, what was it, the euro move into the sell. Let's take a look at that. Right there. Yeah, the euro is in a daily sell. I think that's line 14. 2 full days now in a daily sell there. We were flirting with the weekly buy there yesterday. That's why we have the little circle there, just to give a heads up. And you can see right there, plot 1 is 0, 0, as I would like to say, Z.ZZZZ9. So that is in a plus. And then the plot 6 is the 5 super. And that is at minus Z.ZZ184. So it's flirting with the weekly buy there, just by the edge of itself. And so for those that just are tuning in, that news overall is a very fascinating thing to watch. You're going to have the Congress in Washington fooling around with it today. I'm sure nothing is going to be done. But Pettifor is the more important one. People should pay attention to that. So look up the interview last night of Interactive Brokers, Tom Pettifor. He's did an interview last night that was very insightful. It probably gives you don't even have to watch the congressional circus. Just watch his video of about 4.5 minutes on one of the networks, CNBC, I think it was. And that alone will give you insight of the physical mechanics that the markets are starting to feel. And that's important. Now, when it comes to currencies, you don't have as much of a liquidity problem as you do with these stocks. Most of this stuff is in the stock and stock indices because there's a limited amount of inventory. But whereas the currencies, there's tons of currency, and you don't have to worry about that. That's why it's a good market. It's very liquid. It's got lots of volume. There's a lot of participation. So for trading, currencies are obviously a lot more easier and better to deal with than some of these stock indices and so forth. As we take a sip of our tea here. All right, let's get moving along a little bit more here. You can see, like I said, you can see the pressure on that. Now, cable, we are a cheerleader for cable. You can see cable still in the daily buy. That's line 13, and you're looking at 9 days now in the daily buy there. And not counting the fact of, line 13, 18 weeks in a weekly buy. So the pressure is definitely on the upside. And we've talked about the Commonwealth and so forth. And what's today's high? We're 139.49. So we keep on inching. We were looking for a 138 to 42 range to develop. And we're getting that instant gratification of that pretty quickly here. So we'll just keep on watching the markets move. Did 44 show back up? We're hoping 44 will come back in and we can go through the chart technical analysis information here for them. They flew in and they flew out. So let's just keep on rolling unless someone wants to see anything in particular, and we'll just keep on dancing our way through all this. Let's take a look at Turkish lira. Turkish lira is a little volatility signal and a little pressure on the upside again. Yeah, a little profit taking. I guess that's what we really see there. So let's give that a refresh. Right there. You can see we're doing a little dance there. I don't know how long that will last, but you can see here on the weekly, there's not much love for the idea for it to go up. It's only the pressure and the love is for the downside. And so that's where we are there. Now let's take a look at it on J4X too. We haven't been over to J4X yet. Let's check that out. There's the mouse. Yeah, so here's the Swiss. Pressure is on the upside there. Let's get rid of that right there. And then let's take a look at the Turkish lira over there too. Just flirting. Still flirting with the strength. It's not seeing that. It's not getting the green yet here. It's a little behind. Remember, the Hinky-Ashki is a lagging indicator, but it does match up to our dots overall. So it has a 68% correlation. So that's not too bad. It's it's a good good thing if you're watching Doc's dots. It's a good tool there to keep an eye on. Mohammed, how you been? Why? I can give you the classic. This is what we used to say on the trading floor when someone came into the trading pit and they were out late, or they didn't catch the bell, the opening. They'd say, "Why is that up?" And we used to say, "More buyers than sellers." And if it was down and someone said, "Hey, why is it down?" we'd say, "More sellers than buyers." I would say that there's a rationale slowly sliding in that sterling is a better play than the euro, and that not only will it cater to the Commonwealth of about 1.5 billion to 2 billion people, it will also be catering to some extent to the European Union still because of location. So leaving the European Union and being just an ancillary country on the edge of it allows Britain in many ways to have business with the European Union still, and at the same time, remember, they were being blocked with the Commonwealth. They weren't allowed to do commerce with the Commonwealth because they were part of the European Union. So now what they've done is they've basically increased their customer base, which is pretty good, That's why I'm always kind of a positive bull, just like I'm always a positive bull on the ruble, I always think that the underlying theme is that they want to take the cable up. Let's go back to that. Which mouse was that? This one right there. There we go. And so that's really what I see going on, and we keep on thinking that it's going to fall into the like the 138 to 42ish range. Let's go back to it with J4X2 at the same time, because J4X does show the overall trend a little bit better, because we can not squeeze it as we can squeeze it tighter. And you can see there, we've been in this long weekly buy. When we go back and look at it on a monthly basis, at the beginning of Brexit, it was in the high to mid 40s. I think it played with a 50, but it was definitely playing with the 140s. So that's why we think that the base will become the low end of the 40s. Now this is a weekly chart, and you can see here, it was dancing between the 170s and the 140s. And so what we're thinking is that it's going to build a base on top of here. And, and the channel will be, this channel overall, like the channel that was developed here back between 2009 and 2015 and 16, I guess you could say, before the Brexit started. I would say that they'll develop a channel again on the top of this. And slowly, as better economics and better policy occur, then the product will probably have more strength over time. That's mainly because, again, the physical mechanics. We look at, remember, because you don't have to remember, but due to the fact that we have a quantitative tool that's very precise, it gives us a lot of room to try to understand why things do what they do. And so our quantitative is giving us confidence that there's lots of buyers here. I mean, we're 18 weeks in a weekly buy in our mathematics here. So you can see from early mid-October. And so you can see over here on the fact check spreadsheet on line 13, 18 full weeks now in a weekly buy. At the same time, we see the European Union not really taking any particularly positive direction. In other words, they're not being very competitive, as far as I'm concerned, against England. England is now allowed to be in the Commonwealth actively again. And we're really weird because they were the head of the Commonwealth. The Queen is the head of the Commonwealth. So it was very strange that they couldn't participate in the Commonwealth by being members of the European Union. I mean, you got to wonder who's thinking over there, or I guess you could say who's not thinking there. They would have been better off finding a way to bring in England or the Great Britain into the European Union, linked to the Commonwealth, and then they would have had a couple billion customers. And to me, I've talked about this in webinars for years now. The Commonwealth is important, and they keep on saying, well, the European Union has an average income of about 31,000, and the average Commonwealth income is like 13,000. And I said, yeah, but what about, when you look at Australia and New Zealand and Canada and South Africa and Nigeria and, maybe, Jamaica, throw that in there, and even India on some level. But, I mean, just take India out of it and put some of the weaker ones in there that are dragging down that 13,000. Now, there's a lot of math there that says basically you would really want to be invested in England or Great Britain and not in European Union. So, what do we got there? That is Titus again. Titus says, I listened to the earlier webinar for about a week ago, and you were talking about a 17 trillion loss in the funds or somewhere. What was that about? Yeah, what it is that the quantitative easing by the Federal let me start off from the beginning of that to help you out there. The Federal Reserve and the European Central Bank, the ECB, float about $250 billion a month in new cash. They print that much every month. And then the second question is, well, where does it go? Well, what it does is it goes into the banking system to prop up banks, and they pay interest on it. It goes into they're paying the interest to the central banks. And then it goes also to, that's why it's a negative. And so interest rates are a negative, so they're forced to pay the central bank some money. And at the same time, the clients that come in and buy them because of there's so much cash out there, they just want to know that if they have $1 billion, they want to know that they pretty much have $1 billion when there's a problem. And so, in other words, it's a very big structure, okay? And so, when they talk about like China wants to be a reserve currency and so forth, they don't have the liquidity. They're only 2% of their currency trades on the planet every day. Whereas, you have like 25% or 30% of the dollar trading. And you have like 15-20% of the ECB trading. And then you have like, 8 or 9% of the Japanese yen trading. And then you have about 7-8% of the British pound trading, and then the Swiss is like down around the 3% or 4%. They trade more in Switzerland, I believe, currency-wise than China does. So the physical mechanics are necessary. It would be like trying to put a shoe on that's a size 20 and your foot is a size 30, okay? It doesn't work. You can't get your foot in there. And so it's the same thing with markets. If you're trying to buy and sell something that has a lot of liquidity, you don't have a problem. But if you try to buy and sell in a product that has no liquidity, all of a sudden the bid you see doesn't exist, or the offer that you see doesn't exist. So last week when we were talking about 18 trillion in minus return, what has happened is that they float all this money into the system, the central banks, and it's parked there, and it's not generating a return in profit. So in other words, you as a buyer of it, as a bank or an institution or a fund, you buy it, you have to pay interest to own the bond, not you getting interest from the bond. Okay? I'm going to say that one more time. So you pay interest to the person you bought the bond from, whereas pre-2008, no one ever did that. You buy a bond, you got interest on your money, and they gave you money for buying the bond. They gave you some interest. Nowadays, we have over 18 trillion that does the opposite. So that's what that's all about. Okay? And obviously, the central banks would not be flooding the world with currency or cash, paper, unless there's a problem. And so, there's serious talk about repo market. Now, repos, let me explain what a repo is. What it is, it's a repurchase agreement. All right. What happens? Central banks throughout the last 100 and some odd years would go to the local bank in their country, the local banks, and say, look, you have an awful lot of bonds sitting there. We're going to buy those bonds from you at a little premium, give you a little money, make some money from it. And we're going to give you cash. And then you can take that cash and lend money to investors. Okay? That's what a repurchase agreement. And then there's an opposite side of it. And what happens is when the banks, the central bank, that is, the Federal Reserve or the ECB, thinks there's too much cash in the system, they go to the banks and they tell them, it's time for you to buy some bonds from us. We're going to draw some of your cash away from you. And they have to do that. They don't have a choice. And so there's some mechanics to that right now, and a few $1 trillion that is going to be flooding into the market that's going to really disrupt the repo market. And they may be pulling the cash out of it as fast as they put it into it right now. At the same time, in other words, a squeeze in using short-term cash. And so when you flip back to that question, Titus, about the 17 trillion, that's what that's all about. And so obviously, every month, the ECB and the Federal Reserve are plowing in about $250 billion in new cash. And so obviously there's a concern about the liquidity out there. Now, we don't get a chance to see everything, because they don't like to report it. They like to keep things hidden. And there's no doubt that they try to show us more of the physical mechanics that's going on. But overall, they still hide it. They're still hiding a lot of stuff. I hope that makes some sense to you, Titus. You're welcome to ask a little bit more if you choose to. There's no problem. Like this is the electronic trading pit. So We like to kick around ideas, spitball ideas all the time with no problem. All right. Where did we leave off? Oh yes, so we're looking at the cable there for Muhammad, and so that's what's really going on with the cable. Is that as far as we're concerned, Great Britain is moving into a very positive position financially. It's going to still probably provide goods and services to European countries, and at the same time, it's going to now be allowed to participate much more actively in the Commonwealth, which is over 1.5 billion clients, or people. So there's a lot of a lot of opportunity there. I see. Titus says so. The private bank are in deep problems. Yeah, they've been in deep problems. So in other words, like when you look at like Citibank in the United States, it's trading at 60 some odd dollars a share, but its all-time high is like $670. So it's like 10 times lower than where it's not. If we're at all-time highs in the marketplace, why isn't Citibank trading at say $620 a share, or $650 a share, or $700 a share now? Instead, it's trading at $60 a share. So yeah, and it's the same thing with HSBC and Lloyd's of London, and I guess we can go on about 3 or 4 others, Santander, and Bank of Scotland. And I could name a bunch of banks that are not exactly as well heeled or productive. And then you go and see something like a J.P. Morgan or a Goldman Sachs, who are flying around all-time highs because they did not have the collateralized debt obligation disaster that some of the others did, like Wells Fargo and JPM and Goldman, and like we lost Merrill Lynch. Merrill Lynch is gone. The most prestigious of the brokerage houses here in the United States, that got wiped out, and we lost Bear Stearns, prestigious brokerage house, that got wiped out. Now they didn't go bankrupt because they were forced to be married into other companies to protect the bondholders. See, there's a lot of things that they like to pretend didn't happen that did happen. They like to not talk about it, and the media loves not talking about anything. So I mean, they only do what they're told to do at this point. Are we going to see a repetition of 2.8? I don't see it that way. I could see some mechanical breakdowns, but the days of free markets, free people are kind of gone. The Federal Reserve here in the United States and the ECB and the European Union and the Exchequer in London and so forth, they have what we refer to in America as carte blanche. It's a French word, I guess, meaning that you're allowed to do almost anything you want. The central banks now have the blessing of the governments to do whatever it takes to keep the system working. So remember, 2008 was not as much as a disaster, and it was a disaster. No doubt about it. It changed the whole financial system for good, or at least let's put it this way, until there's a new financial system, a totally different one. And that's what, the excitement is about the cryptos and so forth. And I guess I can say with that, at the same time, after watching Texas and their problems with electricity, you have to be a little concerned about cryptocurrencies in the sense of what if there is no electricity? If there's no electricity, then you don't have your crypto. So will there be another 2008? Not really a 2008. As much as they'll just change the way the banking system works again. That's all. They have the carte blanche to do that at this point. They have the force de jure. They're allowed to do whatever they want now. They float money every day and every week. I mean, they're not printing at the end of the month $250 billion. They're printing it every other day, or every day they're putting some of it into the system. So yeah, there's a problem. There's no doubt about it. Frozen truth. I like that. That's like in a movie, huh? Is 2021 bullish year or a bearish year? I don't think there is such a thing anymore. I have this conversation every so often with some of the old heads from the old exchange days. I don't think there is such a thing as a bull market or a bear market. You just have uptrends and downtrends now. Bull markets and bear markets were kind of a definitive structure of, a cycle, where money came into the market, money took profits, got out of the market. There was instead of, imagine you're a fund. Let's say you're Axe Houghton B, one of the oldest funds in the world, okay, or at least in the United States for sure. And you were a money manager for it, and you were supposed to be 65. You were supposed to have the model portfolio, 65% stocks, 20 some odd percent in commodities, or 15% in no, I'm sorry, not commodities, in bonds. So you had like 65% in stocks. You had 35 in bonds. You had a smorgasbord of bonds, mainly government bonds, but you would probably have some private AAA. Back then in those days, you had General Motors and General Foods and General Electric and General Tire, and I guess, was there any more generals? I guess, companies like that had AAA bonds. Now I think there's only 2 companies in the world now with AAA bonds, corporate bonds. Used to be dozens upon dozens of corporations with AAA bonds. And so the rules say you can be, if you're a certain type of fund, you can be invested in that. Hey, Robin. So what made the bull and bear market concept is that those funds would reduce their position when they saw lower employment and increasing inflation. They would buy maybe 1 to 3% in gold. They would take their stock position to say 65%. They might move it down to say 52%. They might buy, with the bonds, when they took that cash out of the market, they would buy, some more bonds, maybe some short-term bonds, that matured every, 90 days or 120 days, something like that, so they could rotate them. The gold they bought, they would hope that would increase in value to protect the bonds and protect some of the stock, that type of thing. Okay, that was the model portfolio concept, and Graham and all that stuff. What Berkshire Hathaway does today on some level, they do the model portfolio, and that generated bull and bear markets. And then you'd have your crash once in a while, like 1929 or 1987 and things like that, or 2008 crash, 2007 going into 2000, or 2008 going into 2009 crash, things like that. You would have those mild crashes, or wild crashes every so often. And so now, instead, you saw the COVID crash of this year, where the market lost 33%, or it was to last year now. But at the same time, it came back within a couple of weeks, because the central banks now flood the banking system with cash. And so the banks and so forth and the hedge funds have that cash. They got to do something with it. And so what they do is they step in and they pick up stocks and so forth. And so that's pretty much, bull and bear markets used to go on like, 6, 7, 8, 9 months, a year and a half, 2 years. Now they can move in and out over 2 weeks. So I hope that makes some sense to you there. So I'm not a real big fan of bull and bear markets anymore. I don't really believe they exist. I think now you just have uptrends and downtrends. Hey, AR, how you doing? I'll take a sip of my tea and then say, so Frozen, does that make any sense to you? I hope it does. I had one world-renowned option trader call me. I guess it was going into the second week of the last week of February, saying, "Oh, I'm glad you're having a good day." Say to me, it looks like we're going into a bear market, and I said, I don't think we have a bear market. We have uptrends and downtrends. And so then, the next week the market collapsed more, and I said, we're in a downtrend. We're in a weekly sell, and it was like, oh yeah, we're going to be in a bear market now. And 2 weeks later, we're right back where he was talking. The market had moved down 30 some odd percent and was now only down like 8%. And so, when you have central banks now that run the markets, remember, back in the days of bull and bear markets, you had the funds and you had the specialists at the exchanges, running the markets. Now it's the central bank that runs the market. So they have plenty of cash. They can step in and buy or what they can do is they can liquefy the marketplace to the point where it forces everybody to buy. There's just too much cash laying around. They have to do something with it. And so they have to, even if they're only buying 20% of it in stock, that's 20% more than what would have happened before. And 20% when it's 250 billion, you're talking about, what is that? That's $50 billion worth of stock. I think the market is only like a couple $1 trillion total. It's not like it's the currency market. The currency market is trillions and trillions of dollars, whereas the stock market is much smaller. No, I think the market cap of the market is, what is it? It's like 18 or 20 trillion total. That's the total market cap. So in other words, if the stock market went to zero, the world would lose like $20 trillion. That's the market cap. But that's not going to go to zero. Even if it loses 33%, it's only losing like 4 or 5 trillion or 3 trillion. And when you're plowing in 50 billion a month, after 10 months, there's so much cash laying around, and there's not counting the 18 trillion that Titus was asking about. Was it Titus? Yeah, Titus. The 17 trillion. You've got that too. You could always sell some of that and go buy stock with it also. So there's tons of cash everywhere. All right. I hope that makes sense to everybody. I try to remember, I'm really big on the physical mechanics of a marketplace. Since Robin and I are both veterans of the old exchange floors, we are used to open interest and volume and value. Always price discovery. That's the true answer of it all. They used to refer to it as price discovery. Always hunting for price discovery. What is the bid? What's the offer? That's price discovery. What price is it at relative to other products? Like lumber yesterday. Did you see lumber, Robin? I think it went through another all-time high yesterday in lumber. Let's put that up on the screen just for the fun of it. Let's see, which mouse is that? Right there. There is March lumber. It's trading at $986 a board foot now. I mean, Robin traded in that pit when it was $300 a board foot, $275 a board foot. I mean, look at that. That's something, isn't it? Wow. So you buy a foot of, of wood, and they're trading it at $9. Almost 10. Hey, okay, here AR says, "Hey Doc, I have a question. What is your opinion about China A50?" Well, I don't, I don't really trust the data that comes out of China to begin with, and it wouldn't matter that much, about trusting it. But the fact that the world will only trade about 2% of its currency says a lot to me. In other words, that's the physical, mechanical side of it all. I would $1.50 a board foot. Yowzer. Yeah, so I'm leery of China because the world only trades about 2% of its currency. So something's wrong there. In other words, you're supposed to be the second largest economy, okay? And if you're the second largest economy, why aren't you trading like 35% of your currency every day in the open market? Instead, it's fixed and run by the People's Bank of China, and the world only trades 2% of it. So that's what I'm concerned about, is that if the numbers there were real, in other words, they really were the second largest economy in the world, then they should be trading at least equal to the European Union, right? The European Union trades something like I don't know, like 30% of the world currency. And in the United States it's trading like, I don't know, 50-60% of the world's currency, I guess. I don't know when it goes to the percentage of what we're looking at with the China. And then China's trading 2% of world currency. It's like, wait a minute here. And in Japan, it's like in the 12 or 13% area. And so why aren't they at least competing with Japan? Supposedly they're in the same neighborhood. So my lack of confidence of all the numbers that come out of China and the markets there is that specifically. And so that's my concern there. So, we used to call it on the trading floor the cockroach hotel. You ever see those commercials where they catch those little bugs that are in your, in the city and in boxes and so forth? The cockroach, and the cockroach, you can get in, but you can't get out, and something's wrong there. Now Titus says, one more question, please. One more. I always tell you, Titus, it's cheaper by the dozen. You can have about 11, 10 more of them. Why is it we do not see any bigger inflation? Because the banks are not allowed. Now, let's take it a step further. Who polices the private banks? The central banks. In other words, the Federal Reserve, the ECB. They are the bank regulators. Okay. And so they only allow the private banks to lend so much money and to so much risk, a level of risk. And so with all the cash that's sitting around in those private banks being forced into them by the central banks, they're still not allowed to go and lend that money to get it out on the street. And so that's why you don't see the big inflation that you would think normally you would see. $1.50. Isn't that something, Robin? My God, $1.50. Now, the Nikkei, I understand there was an option squeeze. One of the old heads from the options floor sent me a text about 3 days ago saying that there was a squeeze on Sunday night in the options market in Tokyo on the Nikkei. And the Nikkei had gotten up to 30,000, which is pretty impressive. We're looking at a Nikkei that, last time we saw the all-time high of 39,000 was back in 1992, maybe. So 29 years ago, almost 30 years ago. So, that's the answer there. Let's see. Am I answering my rule? Let's see. AR says yep. Robin's saying $1.50 again. Yep. And AR says thank you, Doc. Oh, no problem. So we are. Like I said, we try to do a combination here always. We always not try, we do. We talk about the quantitative, that's what these two bottom charts are. And then, that's what the Chicago Quant Technologies is all about. And then we talk about the fundamentals of supply and demand, the average open interest. Robin has an expression for it. He says, he used to look at the open interest in the volume and say, oh, there's too many fish in the net. And that would mean that more than likely that they were going to go down. And then he'd sometimes look at it and say, oh, look at that. There's not many fish in the net anymore. And then prices would rise again. And so, there's physical mechanics to a marketplace. And not only are you trying to, remember, we're not reactive anymore. Robin and I were raised in a reactive universe. We were on trading floors, on trading desks, and we were reacting to orders coming at us, and we were filling those orders, okay, by being a local or a market maker or just being a floor broker, one of the above. And Robin and I have done all those things. And so nowadays, all those books that are written about how successful everybody is or was or could be or did or whatever, and how they made their money, it wasn't a reactive universe. We are now more in what we call a proactive universe, which means we have to decide why to be long or short. Not someone coming into the trading pit and trying to sell it to us or buy it from us. Instead, we have to figure out, why are we buying this or why are we selling this? And that's what a proactive universe looks like. And that's what we're in now. We're in a proactive universe. And so we use quantitative analysis and technical tools, and the fundamentals don't exist as much anymore. We've talked about this yesterday. Janos has a good old series, well worth watching, even if it's not updated anymore. He's updated it twice. It's well worth watching. It's just the idea for you to appreciate the mechanics of a market and the lack of those mechanics working anymore. Let's see. AR says, Doc, you wait, that gold goes up. Oh, let's take a look at the gold. All right, let's shoot over to gold. I imagine lumber is representing what gold is doing too. Let's see, where are we? Let's take a look at gold. There's gold right there. We're seeing some strength in there today. You can see it through a quantitative math. Let's give it a refresh. Right there. See, we're above the zero line here. You can see it there. We are Z.14 on the plot 1. And plot 4 is Z.12. And so, and then you can see the weekly, though, has been in a downwardly sell here. And we're trying to, I guess some profit taking is going on from the shorts or something of that nature. So there's the gold. Let's see. I'm looking forward to sell GBP cable, dollar. Yeah. Well, I would, I would myself. I'm waiting for the math to turn. Now look at that. Oh, what are we doing? Making new highs again. There, we just made some more new highs. 39.70 now is the high. And so, myself, I'm not too fast to sell that product solely because, again, we really do believe that Great Britain is in a very good position. It'll be able to, do commerce with the European Union, and it will be able to do it is back in the Commonwealth. That puts it out there over 2 billion, maybe 2.5 billion people. That's a lot, to be able to do that type of business. Mohammed says, I'm also looking, but GBP not catchable. I hear you. Right now, our work has been screaming since this little green line here that the trend overall on a week-to-week basis is up. And each week, it gets reconfirmed, and so you don't see the pink. You can see where, it went into the pink here, off of this week right in here, and we put the bar in at the end of the week. And then you could see that, most of that whole week was in a sell. And then it went sideways and built a base and then went into the buy and is climbing, and has been climbing ever since. Let's tighten that up a little bit like that. There we are. And so, it's not right now, there's a lot of positive. You can see it on J4X. There's the monthly here. You can see it's trying to move up into that, 140-ish area. We think that it wants to play the 142 to 138. We've been talking about that for a while around here. And since we're in a weekly buy, we keep on expecting to see it go there, And sure enough, we're watching it climb its way up. If 44 was here, that would be some insight to the 44 to be able to show them how we commingle the government rules or politics and the quantitative analysis with the fundamentals all combined together. The politics was QE, is QE, and what's the other part of it? The rules and regulations of Brexit. And so when they said, "Why do you have to talk about politics?" We don't have a choice. It's thrown in our face, and it has a leash around our trading neck every day, and it has handcuffs on our hands every day. The government is involved every day into the trading market. We don't have a choice about it. So when someone says, why do you have to talk about politics? It's like, why wouldn't you talk about politics? They're the things that move this market. Trust me, private funds are not putting 17 trillion into the marketplace in cash, or 250 billion a month of cash. It's central banks and the governments that are doing that now. So that is that. All right. Where do we go from here? What should we do? Should we go take a look at some of the products? Anybody want to see anything particular? If not, let me just save this. Oh, no, that's cable. I wanted to do the gold. Yeah, there it is, the gold. Let's save the gold. Let's take a look at silver. Silver closed in a daily buy there last night. Let's see what they're doing with that. Right there. There's silver. It's not really lifting as strong as you would think. And it's in a weekly sell to begin with, so it's not, it's all it's doing is saying, don't be short. That's all it really is with that buy. Until we can get this thing into the weekly buy, it's more of a sideways trend or a downtrend, one or the other. And so in this case here, you can see silver, which tried to go into a buy yesterday, which it did. You saw the volatility the day before. And it is pretty much up a little bit for the day by about 10 or 15. Let's see, it closed yesterday at, 27.31 basically. And right now we see it trading at basically the same thing, 27.31, with a high today of 60, basically 59.5. So we're seeing some strength in there, but we're not really seeing the overall trend change. Now, a good example of that type of situation is the natural gas. Let me just save that right there, and then we could let's go over to the energies, and we'll look at the energies. So look at natural gas here. Natural gas finally trying to get into a buy. It's been fighting it for weeks now. We've been in a sell since this whole mess right here, but the problem is that we're in a weekly buy. So you can't be short, and it's keeping you on a leash not to be long at the same time. It's a neutral. And if you're a producer or if you need this stuff, then obviously, the weekly buy is the thing you're paying attention to, since you're short it naturally. In other words, if you're a producer, or you need a certain amount of inventory of natural gas, well, the weekly signal is telling you that you have to be long. You don't have a choice. Whereas if you're a trader, you can just stand it aside, play the strengths on a short-term intraday basis, and just call it a day. I say, hey, George, how you doing? Oh, okay, let's go over to, let's see there, I did the silver. So let's go over to the RAN. So, good, okay. Truth wants to see the RAN. Let's see what the RAN looks like. Let's see, that's right there. There we go. There's the RAN. Let's give it a refresh. Now the RAN went into a weekly sell last week right here, and then they sold it down a little bit going into the rest of the week, and then you can see here they gave it a nice little pop. We went into a buy off of the volatility one right here, so it did protect you on that, not to be short. So your buy is basically right there, the close of this one and the opening of this one. Whereas normally if there was no red dot, it would have been the close of that one you would have bought it. But it's all right, it lets you in there right there. And then you can see it's going the wrong way, and that's because we're in a weekly sell. So you don't want to get really long off of this. You just don't want to be short. Now it's trying to set you back up again, but it needs to go minus here. The white line needs to drop below the zero line. The black histogram needs to drop below the zero line. We need to go down to get into that short there. So right now, there's your weekly trend. Let's take a look back historically. So, you had your sell here, and it went on for a long while, from all the way up until the new year. Then we went into a weekly buy here. Did we go into a weekly buy there? Yeah, plot 1 is 0ZZZ. And, actually, and then plot, what was that? Yes, plot 6 is Z20. So it went into the weekly buy there. I guess we haven't looked at this product so much. So that's the weekly buy. And then what did it do? It went into like a sell there, and then it put pressure on it. What did it do with there? So then it went into a weekly sell. No, it didn't. Didn't go into a weekly sell. Stayed in the weekly buy. Because look at plot 6. It's Z.20, whereas plot 1 is minus Z.01. And then now it's in the weekly sell here from that week. There we are. And it went into the daily sell here, and telling you not to be long. You just couldn't be short yet until you got into here. And then when this started to play down, you could be short here on an intraday basis with no problem, or while this is below the zero line. And so it did make the winner chicken dinner there, just as this made the winner chicken dinner there. Sloppy action overall. You can see the sell from there for days, and then you couldn't get long because it was a red and a green there. I hope that helped you out there, Frozen. I'm sorry. I'm glad you said that. There you go. So there we are there. You can see, the weekly sell here. Then you can see the buy. And you can see the sell. And then you can see matching up with the dailies in there like that. Missing that daily and that daily there. Let's put that in. So Oh no, what did I do wrong there? Okay, let's go right there and do it. So we go like that, and that puts it into the sell, and then we go into that, and that puts it back into the buy. Right there. This one right there. And so, and then let's change the color to this one. And then you can't go into a buy on this one because you have a red and a green there with that. See? Red, green. So it's a sell all the way down to there, but you're in a buy, so you can't take the profit. You can't go short, but you can get out of your long and not give up the money you made here. Okay, where are we at now? Oh, AR says platinum. Let's go check out platinum. Let's see. Where were we? What were we looking at? Oh, that's right. We did gold and silver. Let's go check out platinum. The spread has gone down to 516, I think it was, and now it's around 540 last I looked. Let's see. Where's that? Platinum. Platinum. Right there. There we are. I'll give it a reload. And it's still in a daily buy. It's fighting not to go into the sell. Still in a weekly buy with no problem. Trading at 1275. Let's go to J4X and put gold up there. We can put the spot in there and see what the spread looks like. Right there. So it's trading at 1784. Oh, wow. Okay. And versus 1276. So what is that? That's 508. So the spread is at 508 right now. So that's the action we're seeing there. 508. We've been bullish on this spread since 1000. So this is pretty good. We've been we were looking for it to go down to what, the sixes, and it just blew through the sixes and went to the fives. It's heading for the fours at this point. Let's see. George says, okay, platinum behind again. Okay, I guess anybody else looking for anything? We can just keep on chasing things around here. Let me do this too. I'll save the platinum. Oh, let's take a look at copper. That's the electric motor play. That's the way we're looking at it nowadays. And let's take a look at the copper. There it is right there. Give it a refresh. Yep. Still flying to the moon. Fly me to the moon. Look at this. Went into the weekly buy here, and you caught some of it. Then it went into a sell for a couple days right there, and went back into the daily buy here. And so it's been a winner chicken dinner again. Let's see. Let's save the Copperado. Copper. All right. Now, so that's all the metals. We've looked at the metals. Let's look at the energies. We did look at. Didn't we look at? We looked at this. We looked at the natural gas. Let's just go refresh that again. Oh, what did it do? Natural gas has fallen from. Wasn't it plus just no more than 10 minutes ago? Oh my God. And so we're having problems there. Look at that. They're selling it back down again. How about that? You just never know. I mean, that's what quantitative trading is all about, is the sophistication of being ahead of the curve. And then let's take a look at crude oil. Now, crude oil is showing a little weakness there, but we're in the 61s. Let's give it a refresh. Also, that contract is getting ready to go out, so we might as well change that right now while we're here. Remove that, and let's put in, what is it now? We're looking at April gold now, April oil. Let's put April in there. So that'd be J1 right there. And we'll do this one. J1. And that's April gold. Let's put April up there. Didn't spell that too well, did we? There we go. April. And so you can see here, still in a buy since here. been in a weekly buy for a while now. What's that? Line 5, 12 weeks. A lot of strength in there. I like that. Is that like the Disney movie Frozen Truth? I like that. I think that's a great name. I like that. I like Disney movies. I'm a simple guy. All right. Let's see. What else are we looking at here? So there. Oh yeah. Let's save that. So now, there's the crude. There we go. And so that's kind of a surprise in some ways, or the natural gas did that quick dip out of nowhere, huh? How about that? Let's see now. Let's look at the stock indices. You can see here the pressure is on. We see it. We just haven't. They just won't give it to us. But we're doing all right today, Robin. Maybe we get another exit doorway with the short. And there is the Nasdaq. That's the Tech 100 over here on Dukascopy. Let me just show you that. This is the creme of la creme, the top index in the world at this point, as far as I'm concerned. They say the S&P 500 is, but this one has it all. And there it is, the Tech 100. That's the Nasdaq here in the States. Let's just go to the daily. And then take a look at, look at that. Trying to roll over there. And then here's the S&P 500, which is like the global index in a sense, because 50% of the companies in it are American based, and the other 50% of the companies in it are are outside the United States, international companies. So you can see the pressure there too. The pressure's on, and I think didn't the Nasdaq close in a sell last night? I think it did. Let me just double check that. Let's go back to that for a second. Yeah, it closed in a sell there last night. Don't ask me how that's up now, but last night it was minus and a down, and that's why I had the bar in there. I hate when they change the data on us. It's not reflective of real trading. They just pour it in there just because it's illegal data being slowly put back in there appropriately to make it legal. I hate that. Now the Russell, you can see here the Russell has been in a sell for days now, and that's the one that led us up too. I mean, the Russell was the leader on the way up. It hasn't fallen much, but the Russell is starting to roll over more and more. We'll see. I don't have a lot. There's so much cash out there from the central banks that I don't think there's a lot of room for them to go down to begin with. And then the Dow Jones Industrial Average is trying to do the same thing as we speak right now. There's putting pressure on that. You can see that right there. Matter of fact, it's below the zero line at the moment. The weekly is very close also. We really need to see these things climb into, we've seen them flirt with weekly sells, but they really have not. And, due to the fact of all the capital floating around, it is what it is, No, and you keep on reading. I keep on seeing these headlines about rip your face rallies, and they keep on saying silver wants to go through the roof, and you hear this and you see it talk, but there's a lot of paper out there. We're watching paper trading. We talked about this on Tuesday about the idea you go out and you try to buy physical silver, and there's a premium on it, and then supposedly that you can buy it for cheap, for the fair value, but you have to wait months to get it. So it's crazy. It's all crazy as far as I'm concerned. All right, traders. It's been another fun day. Doc got all the grief and complaints he has in his heart off his chest. And that's what it always is here. Doc does the webinar. Half of it is just to get the angst that I have with what the central banks are doing to our world. And we used to say all the time, free markets, free people, or we used to say free men. Free men, free markets, free markets, free men. Well, those days are basically not what they used to be. That's for sure. So happy trails to you until we meet again, and that'll be on TGIF tomorrow. Happy trails to you, to all our trading friends and cyber friends.